we are going to talk about insurances. If you are going to take a look at the description of the insurances, you have to make sure that you talk about a risk. An insurance is about a risk that people might meet, and the moment that the risk appears, they would like to go to your insurance company because they have got damage and they would like to have the costs covered by the insurance company. In order to get the money back, you have to pay premium. We know different kinds of risks. In the table you see 3 examples. We've got a house might burn down, we've got the car accident, and you might get ill. Different risks. In order to cover the costs that you are going to meet with that risk, you've got different insurances: house on fire, contents insurance, car accident, car insurance. Getting ill, you need a health insurance. The amount of money that you need to pay depends always on the risks. I told you about the careful driver and the careless driver. The careful driver who doesn't speed, who keeps his distance, the risk, the chance that he might cause an accident is very slim compared to the careless driver who speeds, who doesn't keep his distance. So what the insurance company is going to do, the people who have a higher risk are going to pay more premium compared to the person who is very careful. Risk aversion means people don't like risks, and because they don't like risks, they try to cover the risk, they are going to get an insurance. The question, what influences the height of the premium? Is that the number of people, the participants, or the risk itself, or perhaps the average damage? In the table, I made an example with 200 participants. The chance that this risk might appear, that the house might burn down, is 1 on 5,000 a year, and the average damage is 10,000 euros. I'm going to calculate the height of the premium. And always, if you need to calculate the height of the premium, you need 2 ingredients. First of all, you need to know the number of participants. That one is given over here. Second, you need to know how high is the damage. Unfortunately, that one is not given, but you've got some clues on how to calculate the total damage. First of all, you need to know how many houses will burn down a year. It's 1 on 5,000, but we've got 200,000 participants, 200,000 houses. So what you are going to do is you're going to try and find out how many times does the 5,000 fit in the 200,000. That's the reason why I made this calculation. 200,000 divided by 5,000 gives you 4 times a year a house that is going to burn down, that has damage because of a fire. When that happens, you will have approximately 1,000 euros per house damage. So 40 times 10,000 euro means you've got a total damage a year of 400,000 euros. What does every person need to pay? 400,000 divided by all the participants gives me 2 euros. 2 euros. What I'm going to do in the second row, in example 2, is I'm going to increase the participants from 200,000 to 400,000. The chance will be the same. I'm going to try and find out if this affects the height of the premium. When I'm going to use the same method as I use in example 1, you will find out that the height of the premium stays 2 euros. A lot of students think the moment that you increase the participants, in the end, you can divide the total damage over a larger amount of people. But the problem is, the moment that you increase the participants, the chance stays the same. So this one fits more times in this one. So houses will burn down also a lot more with 400,000 houses compared to 200,000 houses. And example 3, I'm going to keep the number of people with 200,000. The chance, however, becomes, the risk becomes bigger. It's 1 on 2,500 houses that will burn down a year, and the damage is the same. I'm going to use the same method once again, and I find out that in the end I will get a premium of €4. Conclusion is that if I'm going to change the chance, the risk that it will happen, that will affect the height of the premium. However, the number of people doesn't affect the height of the premium. Also remember that if you change the average damage, if the average damage was €100, that will also, of course, affect the height of the premium. Why isn't this a profit company? What they do is they calculate based on the chance how much money they need. They are going to collect that money with the premiums, but the problem is they collect the same amount of money as they are going to give back to the people. So they don't have any money left. They're not making any profit at all, and that's not reality. The difference between a bad risk and a good risk. A bad risk, a person, an example, someone who smokes, who doesn't eat healthy, who isn't active in sports, person A. And we've got person B, who doesn't smoke, who eats very healthy, who does his sports, is very active. And we call that person, compared to person A, of course, a good risk. If you could choose as an entrepreneur of an insurance company which customer you would like to have, of course, you would choose the good risk because he will pay the premium, but the chance that he will knock on your door to say, I've got costs that need to be covered is smaller compared to person A, because the chance that he will get ill is bigger compared to person B. Adverse selection. I told you about the careless driver who causes a lot of accidents because the insurance company needs to pay more costs because of the accidents. The insurance company is going to increase the premium, but not only for the careless driver, but for everyone who has that insurance. This continues and continues and continues. The premium goes up and up and up. At a certain moment, when this insurance, of course, is not obligated, compulsory, then he will say, no, this isn't interesting anymore for me. It's a very small chance that I will have a car accident because I'm very careful. And at this moment, the premium is very high. It's far more interesting to save my money on my own, and the moment that I will have costs, I will get the money from that jar. What happens is that the good risks go away. The bad risk, however, well, of course they need to pay more premium, but still a lot of money is covered by the insurance company, so they are going to stay with the insurance company. And of course, you as an entrepreneur would like to make as much money as possible. So you would like to keep the good risks and perhaps hope to see the bad risks leave. And when the other thing happens, you are talking about adverse selection. The other thing happens. Moral hazard. The behavior of customers is changed in a negative way because they have an insurance. The chance that the risk might appear becomes higher because of this behavior. So the moment that you have an insurance for your bicycle, you are very neglectable. You are going to the Bruna and you don't lock your bicycle, and the chance that it might be stolen becomes bigger. Moral hazard. The insurance company doesn't like this at all. And what they do, well, of course, with the insurance for your bicycle, you need to show 2 keys in order to prove that you have done everything to make sure that it wasn't stolen. But also you can also say that they have to pay their own risk. They need to pay the first 100 euros if the risk appears. AOW, you will receive that one from the government. It's for all the people in the Netherlands when they meet that age. Pension is paid with your paycheck, so every employer pays a month a premium for his pension. Financing the social security, the moment that you get ill, you can't work anymore. We've got different benefits within our social security. If you're talking about this one, the Old Age Pension Act, it can be financed in two different ways. We talk about the cost allocation system, and we're going to talk about the capital funding system. We chose the cost allocation system for the Old Age Pension Act because it was in the 1950s that we decided that people could use that benefit. The problem was that people who had the age at that moment, who had the right to use that benefit, didn't save any money at all. So that's why we said the people who are working at this moment are going to pay the premiums, and we are going to use those premiums to pay the benefits. So the cost allocation system, how much money do we need to cover all the benefits in a year? And that money is allocated, verdeeld, over all the people that are working. If you're talking about the capital funding system, with this system, and it's about the pension, that we use this system with the pension, people save money on their own, employers, for their pension. And pension funds invest this money that they receive and hoping to make more money out of this. So only people who paid these premiums will receive this supplement. Yeah? The grey pressure. What happens is, because families are becoming smaller, and we've got the baby boom, of course, we are going to notice that the percentage of people who are older than 50 becomes bigger and bigger and bigger. We are talking about the grey pressure, vergrijzing. The pyramid, if you are going to live on your own after 65, 66, 67, of course all the people will receive the Old Age Pension Act, the benefit. If you have worked, you might also receive your pension. Besides that, people are very afraid, will I have enough money for the future? And that's the reason why they also save money. So they've got three sources to get money from. Altering the Old Age Pension Act, the benefit, we've got two options. We are going to talk about inflation-proof, and we are going to talk about prosperity-linked. The government has got different options what to do with the amount of money that they are going to give away as a benefit. Option A is we're not going to change it at all. It stays, in this example, 1,000 euros. Option B could be we are going to take a look what will happen with the prices. If the prices will go up, inflation, we will increase the benefit with the same percentage. Because of this, the people can buy still the same amount of things that they would like to have. That's one. If this happens, we are going to talk about that the benefit is inflation-proof. The purchasing power stays the same. Option B could be, no, we are not going to increase the benefit with the same percentage as the inflation. No, usually the wages go up way more than the inflation. What we are going to do is we are going to follow the increase of the wages. So the inflation is 2% and the wages go up with 4%. And what we are going to do is we're not going to increase the benefit with 2%. No, we are going to increase it with 4%. We will follow the wages. If that happens, the benefit itself is prosperity linked. And what will happen is your purchasing power will increase. And why? Because your benefit went up with a higher percentage than the inflation. Here's another example where you can find out what happens. We've got the wage or the benefits, 1,000 euro. We've got product A, and we can calculate how many times we can buy product A. We are going to call that the purchasing power. In this case, 100 pieces that I can buy. With option A, I'm going to keep the benefit as it is, 1,000 euros. However, the product itself went up. The price went up. We call this inflation. What will happen over here, if you are going to calculate it, 1,000 divided by 10 euros and 20, you will notice that the purchasing power went down. With this one, what happens? The benefit went up from 1,000 euros to 1,020 euros. It went up with 2%. The inflation in this case is also 2%. So if I'm going to calculate the purchasing power, the calculation would be like this. What will happen is the purchasing power will stay the same. We call this once again inflation proof. The third one, because the wages went up with 4%, the government is also going to increase the benefit with 4%. It will become 1,040 euros. If you are going to divide it by the price of the product, you will notice, if you calculate it, that this person can buy more product A. So the purchasing power went up.